Ladies and gentlemen, what a crazy day on Wall Street. The Dow is outperforming the Nasdaq almost on a 2-to-1 basis. The Russell 2000 is outperforming the Nasdaq by almost 3 times. Why is this happening? What is the data that came out today that's just very strange? How's this affecting the markets? And what's going on with AMC stock? Let's get into the latest that you need to know here in this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section, baby, because I know you got some comments, questions, thoughts, or concerns. So let me hear them in the comment section. So, number one, the data that came out today. What a complete shit show. I mean, that's really the only way to put it. You were expecting the unemployment rate to come in at 3.5%. As of yesterday, the unemployment rate was 3.4%. So that's where we were at. The unemployment rate came in at 3.7%. Now, this is strange because, well, I guess I shouldn't say it's strange, but the way that I seen it is if we get a big move higher in unemployment, that's going to be a negative thing. Like if unemployment were to come in at like 4%, you would get fears about a recession because unemployment going higher, it's going to give you fears of a recession. That's really the only piece that was missing this whole time around. Like that's why coming over the next year, the Bureau of Labor Statistics, I believe that's what it is. Maybe I'm confusing one of the agencies. They're probably not going to deem we were in a recession back in the first 2 quarters of 2022, even though you had negative GDP, because the unemployment rate was super low. So if you start to get that to go higher, it's going to be a problem. Anything over 4% would have been a negative thing. You still came in much hotter than expectations, but it wasn't bad enough. Whereas if the unemployment rate were to fall, that would have probably been a negative thing as well. Non-farm payrolls. This is the real head scratcher here. You were expecting 190,000 job ads. You added 339,000 jobs. And last month's revision was revised about 90,000 jobs. So these jobs just keep popping up. I mean, that's an insane beat. No economist had forecasted over 300,000 jobs. The next highest economist was 250,000 jobs. So on one hand, the unemployment rate, if this trend does continue of the unemployment rate going higher, that's going to mean we're heading to a recession. But you have so many jobs being added on a monthly basis. It's a head scratcher. That's for sure. The market's selling off big tech just a little bit. It's still green today. It's still up 1%. But they're really buying the rest of the markets. And to me, this is a sign of no recession, of Fed rate cuts, and a Fed pause obviously coming first, and then rate cuts following that. So some expectations of Fed easing, just based off of how markets are positioning off of this data today. But then you go ahead and look at what the markets are currently pricing in for the Fed. Markets are expecting June 14th, the Fed to pause with a 63.3% probability. This is really going to come down to the CPI report that comes out June 13th. Depending on how that is, that's really what's going to drive the markets, one way or the other, as far as interpreting the June 14th rate hike or pause. But super strange, markets are expecting a rate hike July 26th, so the next meeting after that, by 50.6% probability. And it's strange because the markets are forecasting interest rates to be between 5.25% and 5.5%. That would mean you would need to see a 25 basis point rate hike in June. So there's still a very strong consensus that there will be a rate hike in June and in July, based off of the July expectations. So it's very strange what is actually happening today. It's really reminiscent of nobody knows anything, kind of what we seen in 2022. The expectations would fly all around based off of different data points that come out. And the thing I'll leave you off with on that, if markets start to interpret the unemployment rate jumping from 3.4% to 3.7% as a recession's coming, as we do start to get more data coming out, that's going to be a negative thing for this market, because Fed policy works with a lag. We know these things, and in my personal opinion, you cannot avoid a recession, and that's because the CPI is a lie. Prices have went up more than CPI says, and wages have not done so. So the amount of goods that you get is substantially less than 2020 or even 2021. If you go to the grocery store, I'm sure you understand that. So people will buy less goods. They will buy less things. Until you get that recession, until you get actual deflation that puts these things more in balance, that brings down the price of goods and lets wages catch up, because wages have really been underperforming compared to inflation. So I plan to make a whole video on this concept, but I think there's no way that you avoid a recession. But I think a recession really comes late in 2023, if not the beginning of 2024. And a part of that has to do with student loans that will need to be repaid starting at the end of July. So stay tuned for that video. That one's probably coming out today, because I think you guys need to hear that. This could really be a time of wealth building for all of you. But let's go ahead and talk about some other things happening in the markets and what to look forward to next. So the big next catalyst, I would personally say, is the OPEC Plus meeting Sunday. Now, OPEC has publicly called out shorts. They've said you better watch out. This next meeting, essentially, they're going to cut production. Now, to what degree do they cut production, and what degree does that do to the price of oil? I guess it depends on the cut amount, right? And that's going to put upward pressure on inflation. At the same time, inflation is really sticky at this point. You're really not seeing too much give on the side of inflation. That could be a big catalyst. And some people are saying that the sell in May, go away thesis, or, you know, kind of saying that's been in the markets for 50 years now, has got pushed back to June because of AI. So people are expecting markets to take a swoon. You're going to start to hear that word. We come up with vocabulary all the time. A swoon in the month of July. So we'll see what happens with that. But as of right now, the market's doing pretty well, which I think is also pretty surprising, considering this data that came out today was really not a positive thing in my personal opinion. Like, none of this was positive. It's pretty clear the Fed's going to pause, but ultimately the economy and a recession is the main fear. That's why in 2022 markets would move up and down so aggressively. It was because of a recession. And ultimately they would do that with the Fed, right? 50 basis points, 75 basis point rate hikes. Because what does that do? What does the Fed raising rates do? It doesn't affect you right away, but it means you're more likely to get a recession. So it's strange, because now you're getting recessionary data, and the markets are only concerned with what the Fed is doing. Eventually, that's going to flip-flop, where markets are no longer going to care as much what the Fed is doing, but they're going to care more about the recession that's coming. So we're going to watch for that flip-flop very closely. And once we identify that, we will let you guys know. If you guys want to stay up to date with all of that and my trades, link down below in the description of this video. Okay, now let's talk about what's going on with AMC stock currently. And boy, is this a strange one as well. The Russell 2000 is up almost 3%. AMC stock is up 0.5%. That doesn't make sense in any world. And I want to say it's a lot of manipulation that's happening today. I do. But you're seeing more of those deep in the money puts that are being placed on AMC today. And when AMC has low volume, there's not much that you can actually do, right? There's just low volume. There's low activity by retail investors, by average investors, by even hedge funds. So like there's not that much shares being traded hands. But market makers, they have to go out and they have to short stock. Now you are positive on the day. Let's not take that away from AMC by any means, because we haven't got a lot of those recently. It's been kind of a straight move down. And as Jim Thanos says, and in this article we're going to go over in the next video that I really want to highlight for you guys, he says that who holds short positions, he holds short positions in AMC. He says when meme stocks rally, the time to enter these trades has already passed. Based on that logic, a brief decline in AMC stock could present a new opportunity to enter the trade. And I think that's where we are at right now. They go on to talk about the court date and how things are probably going to be pretty bullish for AMC in the month of June. And I'm kind of in alignment with that, because after all, we've fallen a lot. At some point, you gotta get a reversal, especially when AMC's fundamentals have actually been getting much better. Now, if you take a look at the Ortex data for AMC, the short score is 92. This is going higher because the days to cover is shooting higher. 3 months ago, days to cover was 5.36. Today, it is 7.31. Almost 2 days to cover. That means it's almost 2 more days, 2 additional days for shorts to get out of their short positions if they wanted to. This is more important than the cost to borrow fees, the utilization, both of those factors. Not more important than the short interest, because you ultimately need that aspect of a short squeeze, but days to cover is the second most important factor to a short squeeze. And that's moving in the right direction. You currently got $507 million worth of short positions on AMC, 21.58% short interest of free float. Free float out on loan at 35.33%, 182.43 million shares that are currently out on loan. Days to cover 7.31. Cost to borrow 57.51 and 100% share utilization. If we go ahead and take a look at the overview of the short interest, 21.7% short interest of free float, 112 million shares currently sold short. Cost to borrow fees are jumping here today. Cost to borrow max 115.35%. Cost to borrow minimum 50%. Cost to borrow average of 69%. Interactive Brokers short availability has a cost to borrow fee of about 65%. So all in all, when you consider these factors, even initiating a position right now, like that's what I'm excited about. Going longer dated on some AMC calls here is what I am personally planning to do. Like I said, if you want access to my trades, link down below in the description of this video. I'm not a financial advisor. I'm not a financial planner. You could lose all of your money, blah, blah, blah. Come join it if you want to grow your knowledge and join a great community. That's that, okay? Now, if we take a look at upcoming catalysts for next week, I just want to run through these briefly for you guys. ISM Services PMI. This will be important considering service inflation is really the stickiest part of inflation that we've seen so far. You're going to get that 10 o'clock in the morning on Monday. On Tuesday, really not going to get all too much on Tuesday. For Wednesday, the balance of trade for April doesn't tend to be a big catalyst. It's highlighted as a big catalyst. Not too big of a deal. And on Friday, nothing much as well. The unemployment rate for the month of May for Canada. And look at them. They're at 5%. America is just strange in the fact that you've seen a record aggressive pace of rate hikes from the Fed and the unemployment rate that has just not moved really at all. It's basically just hit almost historic lows, down to lows that you haven't seen since the 60s. That's insane. So that's basically going to do it for this video. Brief look at the technicals. 50, 100-day moving average. These are the levels that you're probably going to see resistance at, sitting at about $5 per share. You're at $4.56 per share. The next level of support you want to see, $4.31 per share. I'm not convinced we're going to hit there. It looks like you may have bottomed and low wicked at $4.38 per share. You've climbed the last 2 days slightly. So if that serves to be a bottom, well, it's going to be an upward trajectory. I think it really comes down to GME earnings. I think it comes down to the court case on, where we go ultimately from there. But that is going to do it here in this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I'll see you in the next one.